One of the most dangerous things in personal finance is a number that sounds precise but is really just fear wearing a suit: $1,460,000. That is the number many Americans now believe they need to retire comfortably. It sounds serious. It sounds scientific. It sounds like someone must have run a complex model, studied the economy, projected inflation, calculated healthcare costs, and arrived at a precise target. But most of the time, that is not what happened. Most of the time, people were asked what they think they need, and they answered with a number that felt safe. That is very different from math. A feeling can be useful. Fear tells you that something matters. But fear is a terrible calculator. It takes recent headlines, emotional stress, inflation, anxiety, housing costs, grocery bills, political uncertainty, and stories about people running out of money, and it converts all of that into one large, intimidating number. Then that number gets repeated. And once it is repeated enough, people begin to treat it as truth. That is how bad financial decisions begin. Not with stupidity. With a frightening number that was never properly examined. The problem with the $1.46 million retirement number is not that saving a lot of money is bad. Saving aggressively is good. Investing consistently is good. Building more margin than you think you need is usually wise. The problem is that if people believe retirement requires a number so large that it feels impossible, many will stop trying. That is the real danger. If someone hears you need $1.46 million, and they are 40 years old with $50,000 saved, the mind may shut down. It may say, I will never get there. So why bother? That reaction is more damaging than the number itself, because the person may still be able to retire comfortably with a realistic plan, but a fear-based number can make them give up before they do the math. That is why we have to separate fear from calculation in markets, in debt cycles, in retirement planning, and in life. The first principle is always the same: know what is true, not what feels true, not what headlines imply, not what a survey average says, what is actually true for your situation. So let us start by asking where the $1.46 million number comes from. It comes from a survey where thousands of Americans were asked how much money they think they need to retire comfortably. The average answer was $1.46 million. That number was up significantly from the previous year. Now ask yourself a simple question. Did everyone in that survey sit down with their spending, their expected Social Security benefit, their mortgage situation, their tax situation, their healthcare assumptions, their investment return assumptions, and their retirement age? Of course not. Most people answered emotionally. That is not a criticism of them. It is human nature. If people see inflation headlines every day, they feel more danger. If they see grocery prices rise, they feel less secure. If they see housing costs explode, they assume the future will be even more expensive. If they hear that Social Security is in trouble, they assume it will vanish entirely. If they hear about retirees struggling, they imagine themselves in the same position. This is called availability bias. The things that are most recent, vivid, and emotionally intense feel more likely and more important than they may be. Inflation headlines are vivid. A calm retirement spreadsheet is not. So when someone is asked, how much do you need to retire? Their mind does not produce a financial plan. It produces a fear response. A lot, that is the answer. A lot of money. Make the number big enough to feel safe. This is why averages from surveys can be misleading. They tell you what people feel. They do not necessarily tell you what people need. Now, I do not want you to misunderstand me. Many people are underprepared for retirement. Many people are not saving enough. Many people are depending too heavily on hope, Social Security, home equity, or the idea that they will simply keep working forever. That is dangerous. But it is also dangerous to use a target so high that it paralyzes people. Financial planning should create clarity, not despair. The first step is to calculate the actual income you need. A common retirement planning rule says that many people need to replace about 80% of their pre-retirement income. It is not perfect, but it is a useful starting point. Why less than 100%? Because in retirement, certain costs may decline. You may no longer be saving for retirement. Payroll taxes may change. Work-related expenses may fall. Some people may have a paid-off house. Commuting costs may fall. Clothing, lunch, parking, and other job-related costs may decline. That does not mean retirement is cheap. Healthcare may rise, travel may rise, insurance may rise, property taxes may rise. Inflation continues. Life still costs money. But 80% is a reasonable framework for beginning the calculation. The source uses the median household income for people between 55 and 64, roughly $78,000 a year. If you need to replace 80% of that income, the annual retirement income target becomes about $62,400. Now we apply the 4% rule. The 4% rule is one of the most widely used retirement planning frameworks. It suggests that if you withdraw about 4% of your portfolio in the first year of retirement and then adjust that withdrawal for inflation each year, the portfolio has a high historical probability of lasting at least 30 years. It is not a law of nature. It is not a guarantee. It depends on market returns, inflation, asset allocation, sequence of returns, fees, taxes, behavior, and retirement length. But it is a useful tool if you need $62,400 per year and you divide that by 4%, you get $156,000 at this point. The survey number looks reasonable, maybe even low, but we have not included the biggest source of retirement income for many Americans. Social Security, that changes the whole calculation. The average Social Security benefit is around $22,320 per year, or about $1,860 per month. If you are a higher earner, your benefit may be higher. If you had lower lifetime earnings, gaps in work, or claimed early, it may be lower. But for many households, Social Security is real income. It is not a small detail. If your target income is $62,400 and Social Security provides about $22,000, your portfolio does not need to generate the full $62,400. It needs to generate the gap. That gap is about $40,000 per year. Now apply the 4% rule to $40,000, you get $1 million, not $1.46 million, $1 million. That is still a serious number, but it is very different psychologically and mathematically. A $460,000 difference is not small. It can be the difference between feeling retirement is impossible and seeing a path. Now, many people immediately object. They say Social Security will not be there. That fear is understandable. The program has funding issues. Demographics are difficult, more retirees, longer lifespans, fewer workers per retiree, and political conflict all create pressure. But saying Social Security has funding challenges is not the same as saying Social Security goes to zero. That is a major distinction, even in pessimistic projections. Payroll taxes continue flowing into the system. Workers still pay into Social Security. Those ongoing taxes can still fund a significant portion of scheduled benefits, even if trust fund reserves are depleted. The source uses the point that even in a worst-case funding scenario, Social Security may still pay around 78% of scheduled benefits from payroll taxes if that happened. The average annual benefit might fall from about $22,000 to around $17,800. That would be painful, but it is not zero. Now redo the math with a reduced benefit. If your retirement income target is $62,400 and Social Security provides $17,800, your portfolio needs to produce about $44,600, using the 4% rule that requires about $1,115,000, still below $1.46 million. That is why math matters. A fearful person says, Social Security will disappear, so I need everything myself. A thoughtful person says, Social Security may be reduced, so I should run a reduced benefit scenario and plan with margin. Those are very different responses. The second response produces a plan. The first response produces panic. Now, the next variable is even more personal: housing. Housing is often the largest expense in retirement. If you still have a mortgage, you need much more income. If your home is paid off, the math changes dramatically. The source uses an average mortgage payment around $2,300 per month. That is $27,600 per year. If your mortgage is paid off by retirement, you may not need to generate that amount from your portfolio. You will still have costs: property taxes, insurance, maintenance, utilities, repairs, HOA fees in some cases. A paid-off house is not free, but removing the mortgage payment changes the cash flow picture. Suppose your annual expenses fall to $45,000 because your house is paid off. Then subtract Social Security of about $22,000. Now your portfolio needs to generate about $23,000 per year. Using the 4% rule, that requires $575,000, not $1.46,575,000. That is a completely different retirement number. This is why generic retirement targets can be so misleading. One person renting in an expensive city may need a much larger portfolio. Another person with a paid-off home, lower spending, and modest lifestyle needs may need far less. The right number is not universal. The right number is the number that matches your expenses and income sources. That is why the first retirement question should not be, how much does the average American think they need? The first question should be, how much will my life actually cost? This is how to think clearly. Start with annual spending, subtract reliable income sources, apply a withdrawal framework to the gap. Then add a margin of safety, that is math. Now let us look at the 4% rule more carefully because people often use it too mechanically. The 4% rule was built from historical market data. It assumes a diversified portfolio, typically some mix of stocks and bonds. It assumes a retirement period of about 30 years. It assumes withdrawals adjusted for inflation, but it is not a promise. If you retire into a period of poor early market returns, the risk is higher. This is called sequence of returns risk. If the market falls heavily in the first few years of retirement and you are withdrawing at the same time, the portfolio can be damaged even if long-term average returns eventually improve. That is why many retirees need flexibility. If markets perform poorly, you may reduce spending temporarily. If markets perform well, you may have more room. You may hold cash reserves to avoid selling stocks during a crash. You may adjust withdrawals based on market conditions. You may use part-time work, rental income, annuities, pensions, or other income sources. The 4% rule is a framework, not a religion, but it is still useful because it converts spending needs into capital needs. If you need $40,000 a year from your portfolio, roughly $1 million is the starting point. If you need $23,000 a year, roughly $575,000 is the starting point. If you need $80,000 a year, roughly $2 million is the starting point. The number follows the spending. That is the key. Most people think retirement planning begins with a portfolio target. It actually begins with spending. Spending is the engine that determines the portfolio requirement. If you can reduce permanent expenses in retirement, the required portfolio can fall dramatically. This is why paying off a mortgage by retirement can be powerful. It may not always be the highest return financial move before retirement, depending on your mortgage rate and investment alternatives. But from a retirement cash flow perspective, reducing fixed expenses creates flexibility. It lowers the income you must generate. It lowers stress. It reduces sequence risk because fewer withdrawals are required. That is why boring is beautiful. A paid-off house is not exciting on social media. It is powerful on a retirement spreadsheet. Now, this does not mean everyone should rush to pay off a low-rate mortgage early without thinking. If you have a 3% fixed mortgage and can invest at higher long-term returns, the math may favor investing, but the retirement cash flow effect still matters. The right decision depends on rate, age, taxes, risk tolerance, liquidity, and behavior. But the point remains debt. Free housing changes the retirement number. Now let us look at time. Time is the most important variable for younger investors. If you are 30 years old and you invest $500 per month into a broad market index fund, earning an average of 10% annually over the long run, by age 65, you could have around $1.13 million. That is a very important example. $500 per month is not easy for everyone, but it is also not impossible for many households with planning and discipline. It is not $5,000 per month. It is not $10,000 per month. It is $500 per month consistently for a long period of time. That is the power of compounding. The early dollars do the most work because they have the most time. If that same person invests $750 per month, the future value can rise to roughly $1.7 million by 65 under the same return assumption. That exceeds even the scary 1.46 million number. This is why young people need to understand the importance of starting. Not because the first $500 changes everything by itself, because the system needs time. Compounding is like a snowball at first. It looks unimpressive. Then, after enough years, the growth begins to come from the accumulated base, not only from your monthly contributions. Most people quit before the snowball gets large. They say the progress is too slow. But the slow years are the foundation. The first decade may feel boring. The third decade can be extraordinary. That is how exponential growth works. Now, what if you are not 30? What if you are 40 and you feel behind? The source gives a useful example. Suppose you are 40 years old, earning $85,000 a year with $50,000 already saved. Suppose your home will be paid off by age 62. Suppose you invest $600 per month into a broad SP 500 ETF like VO. If the portfolio earns an average of 10% annually, by age 65 it could grow to about $849,000. Now look at the retirement need. If Social Security provides around $24,000 per year, and your house is paid off, and your annual expenses are around $42,000, then your portfolio only needs to cover the difference. That gap is about $18,000 per year. 4% of $849,000 is roughly $34,000. That means the portfolio could generate almost double the needed gap under that framework. The person who thought they needed $1.46 million might have believed retirement was impossible. But the actual math shows a path. This is the central lesson. Being behind does not mean being doomed, But you need an honest calculation. If you are 40, 45, or 50, the plan may require more savings, later retirement, lower expenses, working part-time, paying off debt, downsizing, or using Social Security intelligently, but it may still be achievable. The biggest danger is giving up. A person who thinks the goal is impossible may save nothing. A person who understands the real gap may start saving and investing. Now, the difference over 20 years can be enormous. Now let us talk about the investment vehicle and the source. A broad market index fund, such as an SP 500 ETF like VOO, is a simple way to participate in the growth of major American companies. It is low cost, diversified across many businesses, easy to buy, and historically powerful over long periods. It does not guarantee future returns. The SP 500 can have terrible years. It can fall 20%, 30%, even 50% in severe bear markets. But over long periods, broad ownership of productive companies has rewarded patient investors. The simplicity is the advantage. You do not need to predict the next great company. You do not need to trade constantly. You do not need to follow every economic headline. You buy a diversified basket of businesses. Keep costs low, reinvest, and let time work. That is why index investing is so useful for retirement planning. It removes many mistakes, not all mistakes. You can still panic sell. You can still stop contributing. You can still buy at the top and sell at the bottom. You can still hold too little cash and be forced to liquidate. But a broad index fund eliminates the need to constantly pick winners and losers. That is valuable. The source also mentions other simple fund categories such as dividend-oriented ETFs and growth ETFs like QQQM or SAGE-G. The broader idea is not that everyone must own the exact same funds. The idea is that a simple portfolio can work. You do not need 40 funds. You do not need complicated strategies. You do not need to chase every theme. For most people, the goal is to build a portfolio that is low cost, diversified, understandable, and easy to hold through difficult markets. The best portfolio is not the one that looks smartest in a spreadsheet. It is the one you can actually stick with. That is a very important principle. A portfolio that requires constant attention may fail because life gets busy. A portfolio that is too volatile may fail because the investor panics. A portfolio that is too complex may fail because the investor does not understand what they own. A portfolio with high fees may fail because costs quietly compound against the investor. Simple is not stupid. Simple is durable. Now let us return to the fear number. The number $1.46 million may be too high for many people, but that does not mean it is too high for everyone. A person with high spending, no paid-off home, expensive healthcare needs, early retirement goals, dependents, a high-cost location, or a desire for significant travel may need more than $1.46 million. Another person with modest spending, a paid-off home, good health, Social Security, and a low-cost lifestyle may need much less. That is why using one national number for everyone is foolish. The real number is personal. Your retirement number depends on several variables. Your annual expenses, your Social Security benefit, whether your home is paid off, your retirement age, your investment returns, your tax situation, your health costs, your desired lifestyle, your life expectancy, your risk tolerance, your ability to adjust spending, your inflation assumptions, your other income sources. If someone gives you a universal retirement number without asking those questions, they are not doing planning. They are giving you a headline. Headlines are not plans. Now, the other danger is underestimating. Some people hear that they may need less than $1.46 million and use it as an excuse to save too little. That is also wrong. The purpose of doing the math is not to become complacent. The purpose is to become precise. If the real number is $575,000, that still requires discipline. If the real number is $1 million, that still requires decades of saving and investing for many people. If the real number is $1.2 million, you still need a plan. The math should reduce fear, not effort. That is an important distinction. You should not say, I need less so I can relax. You should say, now I know the target so I can build toward it. A clear target makes action easier. A vague fear makes action harder. Now, let us think about Social Security more carefully. Many younger people assume it will not exist. That assumption may make them save more, which is good, but if it makes them feel hopeless, it is harmful. A more balanced approach is to run scenarios: full benefit, reduced benefit, delayed benefit, early claiming, spousal benefit, no benefit. If you want a very conservative case, then see how the retirement number changes. If your plan works with reduced Social Security, you are more resilient. If your plan only works with full Social Security, You may need more savings or lower expenses. If your plan works with no Social Security, you have a very strong margin of safety, but that may require sacrifices not everyone can make. The key is not to argue, emotionally run the scenarios. Numbers reduce anxiety because they make the problem visible. The same applies to housing. Run the math with the mortgage, run the math without the mortgage, run the math if you downsize, run the math if you rent, run the math if property taxes rise, run the math if insurance rises. Many people assume home ownership automatically solves retirement. It does not. A paid-off house reduces cash flow needs. But maintenance, taxes, insurance, and repairs remain. In some places, those costs are large. Still, eliminating a mortgage can reduce the required portfolio significantly, so include it honestly. Now, healthcare must also be considered. The source focuses on the major retirement income calculation, which is useful. But in real life, healthcare can change the number materially. Medicare helps, but it does not cover everything: premiums, deductibles, prescriptions, dental care, vision care, long-term care, and out-of-pocket costs matter. This is why margin is valuable. If the math says you need $575,000, I would not want exactly $575,000 and no cushion. I would want margin for health care. Inflation, home repairs, market declines, and unexpected needs. The goal is not minimum survival. The goal is comfortable resilience. That is why planning with a margin of safety matters. In investing, I have always believed that the best systems are built to survive being wrong. Retirement planning is the same. Assume some things will go differently from the spreadsheet. Markets may underperform, inflation may be higher, health costs may rise, a spouse may need care, a child may need help. Home repairs may be larger than expected, taxes may change, Social Security may be reduced. If your plan survives only under perfect assumptions, it is not a good plan. If your plan survives several imperfect scenarios, you are much safer. Now let us bring the emotional side back into this. Why do people believe the scary number? Because retirement is not only financial, it is existential. People fear running out of money when they are too old to easily earn it back. That is a rational fear. Running out of money at 85 is very different from being broke at 25. At 25, you can work more, change careers, recover. At 85, options are limited, so people overestimate. They want a number large enough to silence the fear. But no number fully silences fear if there is no plan. A person with $2 million and no understanding of spending can still feel anxious. A person with $800,000, a paid off house, Social Security, low expenses, and a clear plan may feel secure. Security comes from the relationship between assets, income, expenses, and behavior, not from one number alone. That is why the retirement conversation must shift from how much do I need to what system will fund my life. The system includes Social Security, savings, investments, housing, expenses, taxes, healthcare, and spending flexibility. Now, for someone starting today, the most practical path is simple. First, calculate current spending, do not guess. Look at actual expenses. Second, estimate retirement spending. Remove costs that will disappear, like retirement contributions or a paid-off mortgage, but add realistic costs that may rise, like healthcare and insurance. Third, estimate Social Security using the government's tools or a conservative assumption. Fourth, calculate the gap between spending and Social Security. Fifth, multiply the gap by 25 to approximate the portfolio needed under the 4% rule. Sixth, add margin. Seventh, build an investment plan. This is not complicated, but most people skip the calculation and live inside a vague fear. Vague fear is expensive. Clear math is empowering. Now suppose the gap is too large. What then? You have levers: save more, invest longer, work a few more years, delay Social Security, pay off debt. Move to a lower cost area, downsize housing, reduce recurring expenses, increase income before retirement. Use tax-advantaged accounts, build a simpler portfolio with lower fees. Consider part-time work and early retirement. Each lever changes the equation. This is why retirement is not one number, it is a system of trade-offs. If you retire earlier, you need more money. If you retire later, you need less. If you spend more, you need more. If you spend less, you need less. If Social Security is higher, your portfolio need is lower. If your house is paid off, your need may be lower. If healthcare costs rise, your need rises. If returns are lower, you need more savings. The math is dynamic. That is good news because it means you have control over some variables. You cannot control market returns. You cannot control Social Security law. You cannot control inflation. But you can control savings rate, expenses, investment cost, debt, asset allocation, retirement age, and some lifestyle choices. Focus on what you can control. Now, Let us talk about the person who is 30 and can invest $500 per month. That person has a tremendous advantage time if they automate contributions into a broad market fund, avoid panic selling, increase contributions when income rises, and keep fees low. They may not need heroic investment skill. The system can do the heavy lifting. The danger for that person is impatience. They may look at early balances and feel unimpressed. They may chase crypto, options, individual stocks, or hot sectors because the index fund feels boring. They may stop during market downturns. They may spend raises instead of investing more. If they avoid those mistakes, time will work powerfully for the 40-year-old. The advantage is not as large, but it is still meaningful. 25 years is a long time. A disciplined savings plan can still create substantial wealth. The danger for the 40-year-old is discouragement. They may think they are behind and therefore must take excessive risk. They may chase high returns, speculative assets, or unrealistic promises. They may try to make up for lost time with leverage. That can destroy them. A better approach is to increase savings, keep the portfolio simple, use tax-advantaged accounts, reduce expenses, and calculate the real retirement gap for the 50-year-old. The plan may require more trade-offs, but even then, action matters. 10 or 15 years of aggressive saving, debt reduction, and realistic retirement planning can change the outcome materially. It is almost never rational to give up. It is rational to adjust the plan. Now, what about the person who truly cannot save $500 per month? Start smaller. The first goal is not perfection. The first goal is building the habit. $100 a month is better than zero. $200 is better. Automate what you can. Increase contributions by 1% each year. Save part of every raise. Eliminate high-interest debt. Reduce large fixed costs where possible. Look for income increases. The path may be slower, but the system still works. The biggest mistake is waiting until the plan looks perfect. The plan becomes stronger through action. Now, let us examine why a simple index fund works so well for many people. A broad market index fund captures the earnings growth of many companies. Companies innovate, raise prices, cut costs, expand globally, buy back shares, pay dividends, and adapt. Some fail, others rise. The index evolves. That is a powerful mechanism. You do not need to know which individual company will dominate in 20 years. The market will shift, winners will become larger, losers will become smaller. The index will rebalance over time. This does not eliminate volatility, but it reduces the need for constant prediction. Prediction is where most people get into trouble. They think they can jump in and out. They think they can avoid crashes. They think they can identify every turning point. They think they can find the one stock that solves retirement. Most cannot. A simple index portfolio removes many temptations. That is why it is powerful. Now, there are other fund categories such as dividend ETFs and growth ETFs that may fit different goals. A dividend-oriented fund may provide psychological comfort and income focus. A growth fund may provide higher upside but more volatility. A broad fund may provide balance. The exact mix depends on the investor. But the core principle is that the portfolio should be understandable and low cost. If you do not understand your portfolio, you are more likely to abandon it during stress. If fees are high, compounding is reduced. If the portfolio is too complex, rebalancing becomes difficult. If it is too concentrated, one bad cycle can hurt badly. Simple does not mean unplanned. A simple portfolio can be carefully designed. Now, the source says to keep investing simplified. I think that is right. Most people do not need complex financial products. They need a savings rate, an emergency fund, low debt tax, advantaged accounts, broad market exposure, and time. That is the foundation. Then, if they want to add other funds or strategies, they can do so from strength. But complexity should not come before the basics. Retirement is not solved by a clever product. It is solved by the relationship between spending, saving, investing, and time. Now, let us return to the $1.46 million headline one more time. It is not useless. It tells us something important. It tells us Americans are worried. They feel inflation. They feel less confident. They do not trust that retirement will be easy. They see the cost of life rising and assume they need a bigger number. That fear has information inside it. The mistake is treating the fear as the final calculation. A better response is to let the fear motivate action, then use math to create a plan. Fear says, pay attention. Math says, here is what to do. You need both. Fear without math becomes panic. Math without urgency becomes procrastination. A good retirement plan uses urgency and calculation together. Now, if you want to find your real number, do not use the national average as your destiny. Build your personal equation. Annual retirement spending minus Social Security and other reliable income equals portfolio income need. Portfolio income need divided by 4% equals approximate portfolio target. Then adjust for taxes, healthcare, inflation, risk, and personal margin. That is the basic model. If your annual retirement spending is $60,000 and Social Security provides $24,000, your portfolio must provide $36,000 multiplied by 25. That is $900,000. If spending is $45,000 and Social Security provides $22,000, the gap is $23,000. Multiplied by 25, that is $575,000. If spending is $100,000 and Social Security provides $30,000, the gap is $70,000. Multiplied by 25, that is $1.75 million. See how different the numbers are? This is why one headline number is inadequate. Retirement is personal. Now, the biggest advantage you can give yourself is lowering permanent expenses before retirement. Permanent expenses are the fixed costs that must be paid regardless of markets, mortgage, rent, car payment, insurance, debt payments, subscriptions, property taxes, health premiums. If these are high, the portfolio must be larger. If these are controlled, the portfolio can be smaller. That is why lifestyle matters. Not because you should live poorly, because every permanent spending commitment increases the capital required to become free. A car payment in retirement means more portfolio withdrawals. A mortgage means more portfolio withdrawals. Credit card debt means more portfolio withdrawals. Expensive habits mean more portfolio withdrawals. Lower fixed expenses create freedom. This is why a person with a modest lifestyle can retire on less than a person with a high income lifestyle and high fixed costs. Income does not determine retirement comfort by itself, spending does. Now, a paid-off house can be powerful, but it should not create overconfidence. You still need liquidity. A house is not easily spent. If most of your net worth is trapped in home equity and you have little investment portfolio, you may be house rich and cash poor. That creates another kind of risk. So balance matters. Home equity can reduce expenses. A portfolio can provide income, cash can provide flexibility. Social Security can provide a base together. They form a retirement system, do not depend entirely on one piece. Now, taxes also matter. The 4% rule is often discussed before taxes. If your withdrawals come from traditional retirement accounts, they may be taxable. If they come from Roth accounts, qualified withdrawals may be tax-free. If they come from taxable accounts, the tax treatment depends on dividends, capital gains, and cost basis. So the net amount you can spend may differ. This is another reason to add margin. It is also a reason to build tax diversification if possible. Traditional retirement accounts, Roth accounts, taxable brokerage accounts, HSAs, if eligible, each has a role. A more flexible tax structure can make retirement more resilient. Now, inflation remains a risk, even if you calculate the correct number today. Inflation can change the future. The 4% rule adjusts withdrawals for inflation. But if inflation is higher than expected for a long time, the stress increases. This is why owning productive assets matters. Stocks can be volatile, but companies with pricing power may adjust revenues and earnings over time. Real estate can adjust rents in some cases. Cash provides stability but loses purchasing power over long periods if returns lag inflation. Again, balance. Now, the real danger of the $1.46 million headline is that it can push people into one of two bad behaviors. Some people become hopeless and do nothing. Others become anxious and take excessive risk. The hopeless person says, I will never reach it, so why try? The anxious person says, I need huge returns fast, so I will gamble. Both responses are damaging. The right response is disciplined calculation. What do I need? What do I have? What gap remains? How much must I invest monthly? What return assumption is reasonable? What spending changes help? What income changes help? What timeline is realistic? This turns fear into a plan. Now let us look again at the 40-year-old example because it shows the power of realistic planning. 40 years old, $85,000 of income, $50,000 saved, home paid off by $62,600. Invested monthly into a broad SP 500 fund. At 10% average return, about $849,000 by 65. Social Security around $24,000, expenses around $42,000, portfolio gap around $18,000. The portfolio could potentially support around $34,000. That person is not doomed, but if that person only heard you need $1.46 million, they may have never started. This is why clarity is not motivational fluff. Clarity has financial value. A person who starts investing because the math feels possible may end up with hundreds of thousands more than a person who gave up. Now, the 10% return assumption should be treated carefully. The S&P 500 has historically averaged around 10% annually over long periods, but future returns may be lower. The next 25 or 35 years may not match the past. Exactly valuations, demographics, inflation, productivity, and global conditions matter. So run lower return scenarios. What if returns are 7%? What if inflation is higher? What if you retire during a bear market? What if Social Security is reduced? If the plan only works at 10% with perfect conditions? Increase the margin, save more, work longer, reduce expenses, diversify, build cash reserves. But do not let uncertainty stop you from investing. Uncertainty is permanent. The right response to uncertainty is not paralysis. It is margin of safety. Now, if you are older and behind, another lever is working a little longer. Working 2 or 3 extra years can have a surprisingly large effect. You contribute more. Your portfolio has more time to grow. You delay withdrawals. You may increase Social Security benefits if you delay claiming. You may pay down debt. You reduce the number of retirement years the portfolio must fund. This does not mean everyone can or should work longer. Health, job availability, family responsibilities, and personal desire matter. But mathematically, later retirement is one of the strongest levers. Another lever is part-time work. A retiree who earns $10,000 or $15,000 per year from part-time work, consulting, seasonal work, or a small business may dramatically reduce portfolio withdrawals in the early years. That can help protect the portfolio from sequence of returns risk. Again, retirement does not have to be a cliff. It can be a transition: full-time work, part-time work, portfolio income, Social Security, then full retirement. Flexible models can reduce required savings. But flexibility must be planned. Now, the source is focused on showing that the scary number is too high for many people. I agree with that structure, but the deeper lesson is that retirement planning should be individualized. The average number is not your number. Your number comes from your life, your income, your spending, your home, your Social Security, your portfolio, your health, your risk, your choices. That is why you must not outsource your peace of mind to a survey. Now, what should someone do immediately after hearing this? First, stop guessing. Second, calculate. Third, begin or increase automatic investing. Fourth, lower high fixed expenses where possible. Fifth, do not panic about a giant headline. Number 6, do not become complacent if your number is lower. 7th, build a simple portfolio and stick with it. 8th, review the plan annually. That is enough to change the trajectory. The plan does not need to be perfect today. It needs to be real. Most people are not defeated by lack of intelligence. They are defeated by avoidance. They do not want to see the numbers, so they never build the plan. Then the future arrives, and the lack of planning becomes expensive. Looking at the numbers early is an act of responsibility. Now, I want to talk about the psychological difference between fear-based retirement and math-based retirement. Fear-based retirement says, I need a huge number and I am behind. Math-based retirement says, here is my annual expense target. Here is Social Security. Here is the portfolio gap. Here is the monthly investment required, and here is my plan. Fear-based retirement creates shame. Math-based retirement creates steps. Fear-based retirement creates avoidance. Math-based retirement creates action. Fear-based retirement is vague. Math-based retirement is specific. Specific problems are solvable. Vague fears are endless. That is why we want the math. Now, if someone says they want a very comfortable retirement, not just basic survival, then the numbers should reflect that. If travel, gifts to children, hobbies, healthcare cushion, home upgrades, and higher lifestyle are important, include them. Do not pretend you will live on less if you know you will not. Honest spending is better than optimistic planning, but many people overestimate because they have not separated needs, wants, and fears. A good plan separates them: need spending, comfort spending, luxury spending, emergency margin, legacy goals. Each category can be planned. If your base retirement is secure, additional savings can fund comfort and luxury. That is psychologically much healthier than treating the entire future as one giant unknown. Now, let us return to the idea that boring is beautiful. Paying down a mortgage is boring. Buying an index fund is boring. Saving $500 a month is boring. Increasing a contribution by 1% is boring. Keeping fees low is boring. Not panic selling is boring, but boring actions repeated over decades create extraordinary outcomes. The financial industry often makes money by convincing people that boring is not enough. It sells complexity, urgency, predictions, and products. But retirement is usually not won by constant complexity. It is won by consistent behavior. That is why the simple portfolio in the source is powerful. Broad market index fund, dividend-oriented exposure, growth exposure, mostly simple, low-cost, understandable funds. This does not mean that exact mix is right for everyone, but the philosophy is useful. Do not make the portfolio so complicated that you cannot manage it. Let compounding do the work. Now, for a person who is behind, there is one more important point. Do not use the need for higher savings as an excuse to take reckless investment risk. If your retirement number feels challenging, you may be tempted to chase very high returns. Crypto speculation, options trading, concentrated stocks, private deals, high-yield schemes, or promises of guaranteed double-digit returns. Be careful, a bad loss late in the accumulation phase is very difficult to recover from. It is better to combine higher savings, longer time, expense control, and reasonable investing than to gamble. Because you feel behind, the goal is not to catch up overnight. The goal is to become financially secure. Those are different objectives. Now, if you are ahead, do not become arrogant. Markets can change, health can change, inflation can surprise. Family needs can appear, a strong plan still needs margin. The purpose of extra savings is not only a bigger lifestyle, it is resilience. Resilience allows you to handle the unknown without panic. That is what retirement planning is really about. It is not just having a number, it is having enough margin that the future does not control you completely. Now, the final step is to actually act. A retirement calculation is worthless if it does not change behavior. If you find that you need $1 million and you have $50,000, what monthly contribution is required? If you cannot contribute that much, what must change? Income, expenses, retirement age, housing, Social Security claiming age, investment allocation, tax strategy. The numbers should lead to decisions. Decisions should lead to automatic systems. Automatic systems should lead to consistency. Consistency should lead to compounding. Compounding should lead to freedom. That is the chain. Most people break the chain at the first step because the number scares them. Do not do that. The number is there to serve you. You are not there to serve the number. If the number is too high, examine why. Maybe spending is too high. Maybe the retirement age is too early. Maybe Social Security was ignored. Maybe the mortgage will be gone. Maybe the number was just fear. Maybe you need more time. Maybe you need a different plan. There is always a way to improve the equation. Now let me summarize the core logic. A survey says Americans think they need $1.46 million to retire comfortably. That number is based on feelings, not individualized math. A median pre-retirement household income of about $78,000 suggests an 80% replacement target of about $62,400. Using the 4% rule, that target alone implies about $1.56 million, but Social Security changes the gap. Subtract an average Social Security benefit of about $22,000, and the portfolio need becomes around $1 million. Even if Social Security were reduced by about 20%, the needed portfolio may still be around $1.1 million, not $1.46 million. If the house is paid off and expenses fall to around $45,000, the portfolio need can fall to around $575,000. A 30-year-old investing $500 a month may potentially reach more than $1.1 million by 65 under historical market return assumptions. A 40-year-old with $50,000 saved, investing $600 per month, and retiring with a paid-off home may still have a very workable plan. That is the structure. It does not mean everyone is fine. It means the real answer depends on the gap between spending and guaranteed income. That is the number you must calculate, not the survey. Your gap. Now, there is dignity in this process. It removes shame. It removes vague fear. It turns the future into a set of variables. Some variables you cannot control. Some you can. The more you focus on the variables you control, the stronger your future becomes. Save more, invest consistently, keep costs low, avoid bad debt, pay attention to housing. Use Social Security assumptions realistically, run reduced, benefit scenarios, build margin, do not panic, do not give up. Do not let a headline number define your retirement. If you do those things, you are already thinking better than most people. And in money, thinking better leads to behaving better. Behavior leads to results. The final lesson is simple. You may not need $1.46 million to retire comfortably. You need a plan based on your actual life. If your actual life requires $1.46 million, then build toward it. If your actual life requires $1 million, build toward that. If your actual life requires $575,000 because your expenses are low and your house is paid off, then do not let a scary headline make you hopeless. Clarity is wealth because clarity makes action possible. And action repeated for long enough is what creates retirement security, not fear, not headlines, not surveys, a system. That is what you actually need.